Doesn't matter it's a bull market or a bear market, Samir Arora always has a Punjabi tadka in his voice every time when we interact with him. Right, sir? Good morning.
Absolutely.
Okay.
And why not?
Sorry?
And why not?
Of
Punjabi
course, of
people is
course.
Punjabiness.
Of course, of course, of course. So looks like the worst is behind us, at least in the interim. Flows have stabilized. RBI has not increased rates. The valuation concerns are also getting addressed. Is it advantage bulls now for rest of the year?
I've been saying that for some time now, and that at least for this year, that I expect this year to be positive and double-digit positive. And some of it got delayed a little bit because I was expecting the US to have settled down when I was saying this end of last year, and that has got delayed a little bit. But broadly, you are absolutely right that the worst is over and things are stabilizing. And India is, even though in performance wise, has done badly, we can say, but and that is related to China and others. But every day, if you see books, if you see discussions, if you see uh, Twitter, if you see economist cover, everywhere this issue of China versus US is heating up, and that has a big influence on big picture flows into China and corporates going into China and everything associated with it. And India is a beneficiary on that big picture theme for, it'll be a beneficiary for I think many years, but on the margin, a big deal for India.
Samir, so can we assume that the local crisis, which was largely because of Adani and trade deficit, that's behind us, and global crisis, which was largely because of inflation and US regional banks, that's also over?
I would think out of this, the what is happening to the US banks in theory, I don't think is over. We are hoping that the system can handle it because the actual losses in terms of mark to market losses and what percentage they are of US banks and particularly smaller banks and regional banks, that number may be quite high, which basically means that the system has to remain in stable conditions so that there is no panic triggered by these things. I think that is one angle on which I don't have a strong handle as to how to do it beyond just being a strong, that means for the Federal Reserve or for the FDIC and others to be signaling that they are anyway there for any bank that needs their help. Other things I think are over or getting over.
Samir, for the longest time, you've maintained that you've not liked IT, and that call has worked like a charm for you. But after the bout of recent underperformance, is it time to think contra now?
So far, I'm thinking that I will be able to handle any pain if IT does well immediately, because it's not likely to do very well. It might go up in line with the rest of the market, in case I don't mind. But right now, I would not think that why I should step in immediately. First, let's see the guidance of Infosys. TCS, I guess, will not give any guidance. But if you read, like today or yesterday, it came that one of these companies is not honoring commitments to staff freshers. I think that is as bad as it can get. Now you may say, therefore buy when things are bad, but as you separately see, our Indian system doesn't accept openly that there is a slowdown. They say we will be beneficiaries of cost this thing cutting plans, and companies will consolidate and stuff like that, and IT is the key thing. Let them accept it, let them say it in a few quarterly calls and all that, and then we'll see. Right now, I am not thinking that it'll underperform a lot. I am thinking that it won't pain me a lot if I don't have it, so I'll just stay out.
Samir, let's understand the case now. If I look at the markets in terms of commodity consumers versus commodity producers, last 1 year was all about high inflation, impact on margins, decline for commodity consumers. Is the reverse trade at play now for next couple of quarters?
I don't think that reverse play, at least we are not playing that, which would mean that these consumer companies that had very high valuations and which were hit by both high valuations and lower margins because of commodity and all that. Right now, the thing is the slowdown is still there, but more than that, this phase where the market does not like very high valuations for companies that are growing below market, normal market, which means they are growing 8, 10, 12% per annum and expecting that they should get multiples of 40 and 50 on earnings. And people can keep saying, no, no, you should not look at earnings, you should look at some other nonsensical number. But the point is, in the end, earnings takes care of many of these things for such companies which anyway converted a lot of their earnings to cash with or without anybody analyzing it. So the thumb rules work in most of these long held companies or long valued, I mean, who've been around for long, that the valuations are out of line. So, and also the slowdown of the consumer has not gone away. So it will benefit, but the reverse trade we are not playing yet.
So if somebody has to invest the Samir Arora way, will it be all the way again buy into urban consumption, buy into banks? Because that's been the Samir Arora way for last 12 to 18 months. Names like Manyavar or Campus.
No, actually, that is not my way. My way is that I buy 20 to 25 companies in the second group where I'm buying them a little early or sometimes when they might be expensive in somebody's view. But overall, I'm playing with 20 to 25 companies along these three themes, of which today I don't have one theme, which is IT. But otherwise, the three themes are financials, consumer, and IT generally. And then you let the market decide or these companies decide how they evolve over time. It's not to say on any one name that this is the name we have found, but in the group of 25 names, uh, mostly enough outperform to make the whole portfolio outperform. So play it like that instead of committing to any one name, both your money and your ego beyond a point.
So that's the strategy that you're adopting. But let's also understand your view. I know we always have spoken about this, but maybe you want to revisit some other new age tech names in the portfolio now, given the kind of strategy that these companies are adopting. Do you think that this space deserves a relook?
Yeah, so we have two names in these 25 names, which are Paytm and Zomato. Paytm, of course, we have got good timing, so we are up some 20-25%. Zomato, we were up and then it went back, so now we are zero. But both these are big brands, big survivors. And although, like for example, you read recently that Reliance is coming into cosmetics or trying to compete with Nike and stuff like that, nobody is going to announce, new person is going to say that we are going into food delivery or going into even payment business so easily. And therefore these guys are now in a place where previously there may have been 20 guys and now they are, in the case of food delivery, down to 2, and there is no way a third guy can come in. And in this, one of the two is unlisted, and if they compete too hard and think that by getting a few more market share points here or there, they can have a hope of getting listed, that also does not work unless Zomato does well. So I think that the steady state solution will be that Swiggy will back off, let the Zomato win a little bit in the market so that some years or months later, maybe 1 year later, it can hope to go public. Otherwise, it can keep fighting without having ability to get listed, because the market will not accept a second name in exactly the same business with nearly exactly the same market share, with nearly exactly the same number of riders, with nearly exactly the same number of restaurant partners, and the first guy not doing well. It is just big picture in this case. But beyond that, it's an optionality, because the second business, which is Blinkit, also seems to be progressing well, and over time that would be worth a little bit on its own. Plus both these guys, that is Zomato and Paytm, have $1 billion cash kind of thing. So it's okay for now. It's both are optionality businesses, and so far so good.
You realize that Samir also saw the ad in which we have 9,000 Nayantara.
Yes.
And
Yes.
yeah, one of the
Nayantara's-
models. He's calling it
Nayantara's-
Zomato, not
I saw
Zomato.
Oh, did she send it? You know, it's so true. It's one of those brands जो घर घर का brand बन चुका है. It's just that you don't
Still
know how.
mispronounce.
Still,
You
that is
don't
what
know
it happens.
Zomato hai ki Zomato hai.
So Samir,
Right, Samir?
was it
I
Zomato
go
or
with
Zomato?
I go with Zomato.
Zomato, yeah.
Uh, Typically, when interest rates peak out, growth stocks they make a comeback. Would you buy into this good old valuation argument that interest rates comes down, growth stocks they start moving higher, and value stocks they start coming down?
So that is what I was saying, that normally that would have been the case, but the valuations of these so-called very high valuation companies, which are growth rates are not very high, mostly these consumer companies, which used to all their life, when I remember investing in them, which was not very long ago, maybe 5 years ago, and for its previous 10, 20 years, would trade in the multiples of 30s and maybe sometimes reach 35, 38, 40 multiple on earnings. And this cash business that no, you should look at cash, all these guys who got 35, 40 multiple were anyway very good at converting to cash their earnings, and that's why they got these multiples. Otherwise, they were always a Tata Steel and something else available at 5p. So that everybody in the market understood 10 years ago also. Till this story was a bit oversold by saying that if you convert something to cash, don't look at P. And these P's became 50 and 60. And in the meantime, the earnings growth of these companies came to GDP in nominal terms and lower because of maybe a little bit higher penetration already and therefore a little bit of saturation. And mostly then because there is so much new entrants in these businesses, and also people's preference for what they want to spend money on change, because now they want to buy a mobile phone and things like that, which then has to substitute for something else. So therefore we are not buying these high P but not high growth, just 10-12% earnings growth, and saying that it is stable, so let me give 40-50 P. That's what I was saying in the beginning.
I was just scanning through data, and there are a lot of historical correlations which have not worked this time. Correlation number one, weakness in dollar index and strength in commodities. That has not worked. Correlation number two, in the first hike of an interest rate cycle, equity markets they always do well. That has not happened. Why some of these historical correlations have been broken?
For the second one is that because I'm assuming you're talking from the US point of view, which might have influenced us, is because this time the difference in terms of how much was the targeted inflation and how much inflation had reached was so high. I think it was the biggest that I've seen in 25 years. And the language of the Federal Reserve and the commitment that they had, and of course this has been the biggest hike ever. So maybe the market anticipated that it is not just one hike and therefore after two hikes things will be okay. It was clear that there will be 10, 12 hikes if it was counted in terms of quarter percent. And they have been very big hikes. So maybe the people looked beyond the first hikes and stuff like that.
And on the first correlation, weakness in dollar index is always strength in commodities. That also has not played out this time?
That may have to do more with China. Actually, the reason why I have not been bullish on commodities, although generally I'm not bullish, but every time you need some angle, is that this time the market, I think, wrongly perceived that China opening is a commodity positive trade, because this time China opening was more a consumer related issue, that these guys have not been able to travel and they were locked in their cities, so they didn't go to the local Starbucks and stuff like that, rather than that some projects were stuck. And when the zero COVID policy was removed, that suddenly all those projects that were stuck or the investments that had to be made could now be made. I don't see from where people got a positive commodity cycle connected to opening up of China, which I thought was more consumer related opening in this round. But I don't know exactly in which phase you're talking. Generally, anyway, I don't like commodities, so I find all excuses I can to argue against it.
Right, Samir, always good chatting with you and always good having you on the show. Let you go on that note.